This is Thursday, February 19th, 2026, and in the last 48 hours, something has happened that should not be possible in a functioning market. The Federal Reserve, the institution that the entire financial world has been waiting on to cut interest rates, just sent a signal that stopped every single investor in their tracks. Fed officials, speaking through the release of the January meeting minutes, suggested that rate hikes may be back on the table. At the exact same moment, silver is sitting at $78 an ounce, more than double what it was just 13 months ago. And gold is at $4,990, knocking on the door of a number that has never been touched in human history. $5,000 per ounce. Meanwhile, COMEX, the exchange where silver futures are supposed to be settled in physical metal, is 8 days away from first notice day on March contracts. And registered inventories on that exchange are down nearly 70% from where they stood just 5 years ago. A rate hike signal, record precious metals prices, and a delivery crunch, all colliding in the same 72-hour window. If you are watching this and you feel confused or scared or like nothing in this market makes any sense right now, I need you to stop, take a breath, and watch this entire video. Because what I am about to show you does not make any sense. The numbers do not add up. The story the market is telling you is not the real story. Think about what we are being asked to believe. The Federal Reserve may raise interest rates. Historically, rising rates are bad for gold. Rising rates are bad for silver. That is the conventional wisdom. That is what every textbook says. That is what Wall Street has been telling retail investors for decades. But gold is at $4,990. Silver is at $78. These are not the prices of assets that are afraid of higher rates. Let me say that again so it sinks in. If interest rate hikes were truly bad for precious metals, why are both gold and silver trading at or near all-time records on the exact day the Fed signals it might hike? Does that make sense to you? Does that sound like a normal market responding to normal signals? Something is very wrong. And by the end of this video, you will understand exactly what it is. If you are new here, welcome. This channel exists to cut through the noise, to give you the analysis that the mainstream financial media refuses to deliver, and to help you understand what is actually happening, not what the institutions want you to think is happening. If that is the kind of content you need right now, please subscribe and hit the bell, because what I am going to show you today is the kind of analysis you will not find anywhere else. Let me take you back to just a few weeks ago. On January 29th, 2026, silver hit $122 per ounce. That was an all-time high. And if you watched this channel, you knew it was coming. I told you the supply fundamentals were broken. I told you the paper market was dangerously disconnected from the physical market. I told you that when the squeeze came, it would come fast, and it would come hard. What I did not expect, and I want to be transparent with you, is what happened next. Within days of that all-time high, silver collapsed nearly 50% in a historic sell-off. Nearly 50%. A metal with broken supply fundamentals, a metal with record industrial demand, a metal with collapsing inventories globally, just lost half its value in a matter of days. And yet, here we are less than a month later, and silver has recovered to $78. Let that sink in. The question I did not fully anticipate was not whether silver would crash. The question I did not anticipate was who was on the other side of that crash. And that is what we need to talk about. But here's something I also did not anticipate: the speed and the mechanism of that recovery. Because silver did not recover because new supply disappeared. It did not recover because industrial demand suddenly collapsed. It recovered because the physical buyers, the real buyers, the ones who take delivery, stepped in immediately when the paper price fell. That tells you something critical about where we are. It tells you the physical floor is much higher than most people realize. And it tells you that the entities responsible for crashing the price on paper do not control what happens when the physical world pushes back. 3 things I did not fully expect: the scale of the Chinese regulatory intervention, the speed of the recovery, and the fact that the Federal Reserve would choose this exact moment to reintroduce rate hike language. All 3 of those surprises point in the same direction, and that is what we need to talk about. Let me explain how the silver market works, because most people do not understand this, and that misunderstanding is costing them money. There are actually 2 separate silver markets operating simultaneously. You need to understand both of them to understand what is happening right now. The first is the paper market. This is the futures market, COMEX in New York, the London Bullion Market Association, and the derivatives markets that hang off them like a shadow economy. In this market, you buy and sell contracts that represent silver. Contracts for silver that, in most cases, will never be physically delivered. Estimates suggest that for every 1 ounce of real physical silver in the world, somewhere between 200 and 300 paper ounces are traded. The paper market is like a giant poker game where most players never actually cash out their chips. They just trade chips with each other, and the casino takes a cut every time. The second market is the physical market. This is where you walk into a coin dealer, where a manufacturer buys silver for solar panels or semiconductors or medical equipment. This is where governments acquire silver for strategic reserves. This is where the metal actually changes hands. And here's what you need to understand. These two markets have been operating as if they are completely separate realities, and the divergence between them is now so extreme that the system is beginning to break. But here is where it gets truly alarming. Let me walk you through the evidence piece by piece. Pay very close attention, because each of these data points on its own is interesting. Together, they are explosive. CME Group, the operator of COMEX, the most important silver futures exchange in the United States, raised margin requirements for 5,000-ounce silver futures contracts to 18%, up from 15%. That is a 20% increase in the collateral you need to hold a position. CME does not raise margins for fun. CME raises margins when it is afraid, when it sees too much concentrated risk, when it sees a delivery squeeze forming that it cannot easily manage. That is a panic signal from the institution that runs the market. Let that sink in. Now look at COMEX registered inventories. Registered inventory is the silver that is actually available right now, today, to be delivered against futures contracts. 5 years ago, there was a substantial buffer in those vaults. Today, that buffer is down nearly 70%. 70% of the deliverable silver supply, gone. At the same time, over in London, the LBMA, the London Bullion Market Association, the other great pillar of the global paper silver market, has seen its vaults drain approximately 40% since 2020. And in Shanghai, Shanghai warehouses are holding their lowest silver inventory in a decade. Let me connect those dots for you. New York vaults down 70%, London vaults down 40%, Shanghai at a decade low. When New York, London, and Shanghai are all experiencing the same drainage at the same time, that is not coincidence. That is not three separate local problems. That is a global structural shortage of physical silver hiding behind a paper price that still pretends everything is fine. But it gets worse. February 27th, 2026 is first notice day for March COMEX silver futures contracts. That is 8 days from now. First notice day is when holders of futures contracts who want physical delivery must formally declare their intention. And the size of open interest going into this delivery cycle is significant. The question that every serious analyst in this space is asking right now is how many of those contracts will stand for physical delivery? Because if even a fraction more than usual demand real silver, not a cash settlement, not a roll, not a paper alternative, but actual silver in a vault, the registered inventory numbers I just showed you suggest that COMEX may not have enough metal to meet that demand. That has never happened in the modern era. And the CME's decision to raise margins right now, 8 days before first notice day, tells you they are worried about exactly that scenario. That is not a precaution. That is a signal. Now let me tell you what happened in China, because this is perhaps the most important part of this entire video. During the run-up to silver's all-time high on January 29th, a financial instrument in China, the UBS SDIC Silver Futures Fund, was trading at a 36% premium over its net asset value. 36%. That means investors in China were so desperate to gain exposure to silver that they were paying 36 cents extra for every dollar of silver value. That is not investment. That is panic buying. That is a population that has watched its property market collapse, watched its stock market struggle, and concluded that silver is the escape hatch. Chinese regulators, alarmed by this frenzy, suspended that fund from accepting new investment. That emergency suspension helped trigger the 50% price collapse that followed. Here's what you need to understand. The crash in silver was not driven by supply appearing. It was not driven by industrial demand collapsing. It was driven by a regulatory intervention in one country's retail investment market. The paper price crashed. The physical reality did not change. Not 1 ton of new silver appeared in the world's warehouses because of that crash. Let that sink in. And now the Federal Reserve enters this picture, and the dynamic becomes genuinely extraordinary. The January Fed meeting minutes, released on February 18th, revealed that several Federal Reserve officials discussed the possibility of raising interest rates if inflation remained stubborn. The market had expected rate cuts. The market had priced in rate cuts. Rate cuts are supposed to weaken the dollar and push precious metals higher. Rate hikes are supposed to do the opposite: strengthen the dollar, weaken gold, weaken silver. And yet, gold is at $4,990, and silver is at $78. The traditional playbook is not working. Let me show you why. When you have a physical supply crisis, a real, structural, inventory level shortage, the price of that physical commodity will find its true level regardless of what happens on the paper exchanges. Rising interest rates can suppress the paper price. But if the physical market is broken, if manufacturers cannot source silver for their solar panels and their semiconductors, if mints cannot deliver coins, if COMEX vaults are 70% depleted, the paper price becomes increasingly irrelevant to the real price. We are watching in real time as those two prices begin to divorce from each other. And divorces, once they start, do not stop quietly. Here's what you need to understand about the gold-silver ratio right now, because it tells the real story better than any single price. The gold-silver ratio is currently sitting above 95 to 1. That means it takes 95 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged around 60 to 1 over the long run. In periods of genuine silver scarcity and monetary stress, it has compressed dramatically, sometimes to 30 to 1 or below. What 95 to 1 tells you is that on a relative basis, silver is extraordinarily cheap compared to gold. Not cheap in dollar terms, $78 is not cheap, but cheap relative to what gold is pricing in about the state of the monetary system. The institutions that know what is coming are buying gold. They are telling you to sell silver. And that gap, that 95 to 1 gap, is the opportunity, or the warning, depending on which side of the trade you are on. Let me connect all of this together for you, because there is a coherent story here that the mainstream media is not telling. Global silver inventories in New York, London, and Shanghai have been systematically drained over the last 5 years, to the point where a physical delivery crisis is no longer a theoretical risk. It is an imminent mathematical reality. The paper silver market experienced a historic crash in late January, not because of any change in physical fundamentals, but because of a regulatory intervention targeting leveraged retail speculation in China. This crash was manufactured, or at minimum dramatically amplified, by forces that had nothing to do with supply and demand. The Federal Reserve is now threatening to raise interest rates, which, under normal circumstances, would suppress precious metals. And yet, gold is at $4,990 and silver is at $78, because the market is beginning to price in the physical reality, not the paper narrative. And COMEX First Notice Day arrives in 8 days, with registered inventories at historic lows and margin requirements just raised. And the institution that runs this market is visibly nervous. I believe we are approaching a breaking point, not a short-term price fluctuation, a structural breaking point where the paper price and the physical price can no longer coexist. Now let me tell you what this means for you, and I am going to be very direct here, no sugarcoating. If you are currently holding physical silver and gold, the actual metal, in your hand or in an allocated vault, you are holding the only form of wealth in this story that is provably real. You are not holding a promise, you are not holding a derivative. You are holding the thing that every institution, every central bank, every industrial manufacturer ultimately needs. Do not let a paper price crash shake you out of a position that is based on physical reality. If you are holding silver or gold ETFs or unallocated accounts or paper derivatives, I want you to ask yourself a very serious question tonight. In a scenario where COMEX faces a delivery failure, where physical silver genuinely cannot be sourced in the volumes the paper market implies exist, what exactly do you own? A piece of paper that promises you silver, and the entity that made that promise may not be able to keep it. I am not saying that will happen next week. I am saying the risk of that outcome is higher right now than it has ever been in the modern era, and most people who own paper silver have never once considered it. And if you are sitting on the sidelines, trying to time this market, waiting for a cheaper entry point, understand what you are waiting for. You are waiting for the paper price to fall again. But the physical market is telling a completely different story. Every time the paper price has crashed in the last 6 months, physical dealers have reported buying surges, not selling surges. The retail investor who understands this is buying on paper dips. The retail investor who does not understand this is being frightened out of the market by paper moves that have increasingly little to do with physical reality. Some people will say this is conspiracy theory, that I am manufacturing a crisis that does not exist. To those people I say, look at the evidence. CME raised margins to 18% with 8 days to First Notice Day. COMEX registered inventories are down 70% in 5 years. LBMA vaults are down 40%. Shanghai is at a decade low. China's largest retail silver fund was suspended for trading at a 36% premium. Silver hit $122, crashed 50% in days due to a regulatory event, and has already recovered to $78. The Fed is signaling rate hikes while gold trades at $4,990, behavior that breaks every historical precedent for how precious metals respond to monetary tightening. That is not conspiracy. That is data. That is facts. That is reality. Let me show you the bigger picture, because what is happening today did not start today. Silver's supply deficit has been building for years. Total above-ground silver stocks have been declining since 2015 as industrial consumption, driven by the explosive growth of solar panels, electric vehicles, 5G infrastructure, and advanced medical technology, has outstripped mining output every single year. The Silver Institute has published data showing that silver demand for photovoltaic solar applications alone has increased by over 300% in 4 years. And this is not a demand story that ends. The global energy transition is not reversing. Every solar panel installed on a rooftop or in a field permanently removes silver from the investable supply. The silver is consumed. It is not recycled at economically viable rates. It is gone. What we are looking at is not a short-term supply disruption. This is a structural problem that has been building for nearly a decade, hidden by a paper market that could always conjure more paper ounces when needed. And now that structural problem is beginning to surface at the physical level, in the vaults of the 3 most important silver trading centers in the world simultaneously. Think of it like a bathtub with the drain left open. For years, institutions papered over the outflow by printing more contracts, more ETFs, more paper promises. But now the bathtub is running low. You can still see water, but you can also see the bottom. And that is new. That is what has never happened before in the modern era of this market. This is not a short-term issue. This is a structural problem. And structural problems do not resolve quietly. Now let me tell you what I believe happens next. COMEX First Notice Day on February 27th is the immediate test. If physical delivery demand on March contracts is abnormally high, and given the current state of inventories and the visible nervousness from CME's own margin hike, there are serious reasons to believe it could be. We may see cash settlement offers being made to contract holders at premiums above spot price. That is not a default in the legal sense, but it is a signal that the paper market cannot fully meet its physical obligations. If that happens, the divergence between paper price and physical price will become undeniable, and the narrative that the paper price is the real price will begin to collapse publicly. Beyond the immediate delivery cycle, I believe the gold-silver ratio will begin compressing. If it reverts even to 60-1, which would still be historically elevated, and if gold holds anywhere near $5,000, we are talking about a silver price well above $80. If it reverts to 40-1, the historical norm, the implied silver price at $5,000 gold is $125 per ounce. I am not saying that will happen tomorrow. I am not saying the path will be straight or painless. The January crash proved that the paper market can still inflict serious short-term damage. But the fundamental dynamic is the same as every supply squeeze in history. The question is not if, the question is when. And the evidence I have shown you tonight suggests the when is very close. Now there are 3 types of people watching this video right now. The first type is scared. They watched silver crash 50% in late January. They are watching the Fed signal rate hikes, and they are wondering if everything they believed about precious metals is wrong. If that is you, the crash happened on paper, not in the vaults. The fundamentals did not change. Not 1 ounce of new supply appeared. Not one factory stopped needing silver. The physical floor held. And silver proved that by recovering to $78 faster than anyone expected. The second type is confused. They can see that something unusual is happening. They can feel the tension in this market, but they cannot quite piece together how a rate hike signal, a China fund suspension, and a COMEX inventory drain are all part of the same story. If that is you, I hope this video has connected those dots, because they are all connected. They are all pointing in the same direction. The third type already understands exactly what is unfolding. They have been stacking physical metal, they rode the crash without panic selling, and they are watching these institutional signals with quiet intensity. If that is you, you know what to do. Which type are you? Let me know in the comments below, because the conversation in this community is some of the most valuable analysis I have access to. So let me bring this full circle, because the contradiction I opened with is still sitting there, unresolved, demanding your attention. The Federal Reserve is signaling rate hikes. Historically, the playbook says, sell gold, sell silver. And yet, gold is at $4,990. Silver is at $78. COMEX vaults are down 70%. London vaults are down 40%. Shanghai is at a 10-year low. CME just raised margins 8 days before first notice day. China's retail silver fund was suspended for trading at a 36% premium before crashing 50%, and silver has already recovered most of those losses. One of these things is a lie: the rate hike signal or the physical vaults, the paper price or the actual metal. And it is not the vaults that are lying to you. The paper market is telling you silver is just a commodity, just another line on a chart, just another instrument to be traded and shorted and settled in cash. The physical vaults are telling you something completely different. They are telling you that silver, real silver, the metal, the element, the irreplaceable industrial and monetary asset is becoming genuinely scarce. And that scarcity is not fully in the price yet, but it is about to become one. You get to decide which side of that story you want to be on. If this video gave you something valuable today, you know where the subscribe button is. Drop a comment below and tell me which of those 3 types of investor you are right now, because I read every single one. That is not a market, that is a magic trick, and now you know how the trick works.